Forever, wherever you are situated. We're just going to give it like 20 more seconds, like give everyone a chance to join in, and then we'll get straight into it. Let's get started. So that, and I know it's already 4 minutes past the hour. So welcome everyone. Thank you so much for joining us. This is our second, I guess, last webinar for the year. So I wanted to take this opportunity. We are in a very interesting time of the year. So much happening on the global markets, and especially looking at the AI portfolios and the performance and where we are at currently in the current investment cycle. So we thought it was a good opportunity to take this time today to go through what we've seen throughout this year, what is yet to come, and especially now we've got the election coming up in the next few days already. So that should be very interesting to watch, especially the impact that this will have on our portfolios and our AI portfolios as well. So without further ado, let me introduce you to Jorge, which obviously needs no introduction. He's been a fantastic presenter for us for the past webinars. So Jorge, welcome. Thank you so much for joining us. I know it's quite early on your side, but thank you so much. It's a pleasure to have you again with us today to go through what we've seen is, I mean, I've seen that before the call, just a very exciting presentation that we'll go through today. If you have any questions, please feel free to send them through the chat, or we're happy to take questions throughout the webinar as well, if you want to keep them at the end or as we keep into the webinar. If there's anything else that comes through afterwards, don't hesitate send this to me as well. But Jorge, the floor is yours. I can't wait to hear what we have on today's session.
Thank you very much, Anne. I really appreciate the invitation to participate in these webinars and these calls, because I think they are good to catch up on a quarterly basis, review the markets, and review current events. So I do appreciate the time So good morning or good afternoon to everyone. It's 8 a.m. in the Eastern Coast here in the United States. And the idea of the presentation this morning is to really walk through sort of the summary of what we're seeing in the markets, review past calls, past things that we've discussed, but really look at the main topics of the day, which obviously we have elections, U.S. elections next Tuesday. And so things are wrapping up. So we'll touch on what that means in terms of to the economy, to the financial markets. But more importantly, we'll talk about really is inflation and interest rates, economic growth and consumption for the past 2 years, and what we can see, what we can expect for the next several quarters or for the next year, given what we can see from fiscal policy based on the elections and where we are in the economic cycle. So that's what I like to focus on. And then I will also focus on the performance of the financial markets. And then I'll finish off with the performance of our ETF portfolios that utilize artificial intelligence to do the asset allocation, which is a very differentiated investment solution to the market, is very tactical, and I'll demonstrate a couple of interesting things about it and obviously performance. So I will start with the elections. This is a busy chart, but mainly we have Donald Trump and we have Kamala Harris who represent each party, and they have separate, distinct agendas. Both parties, however, if you look at their economic platforms, it's really to stimulate the economy. So I think of what we discussed in prior calls. I think we discussed it in the first quarter of this year, and what we saw is that the equity markets, the economy, tends to do very well in election years, and this year is no different to that. We've had very strong markets. But that's been supported by really, the interest rates and inflation. So in terms of political agendas. We know that if Donald Trump wins, he could be supportive for several industries. He can lower the corporate taxes, so it could be good for the economy as well. And then he can also favor several industries. On the other side of it is, he may impose tariffs, which may be inflationary, and he does have a very strict immigration policy that we have to see how that spells out into the economy. But overall, his economic proposals are constructive to allow the economy continue to grow. On the other side, when we have Kamala Harris, she's sort of a continuation of the current policies, and again, the current policies that the U.S. economy continues to grow. The financial markets, the Standard & Poor's, the equity markets continue to do very well, and we're at historic highs. Interest rates remain very low. So the sort of the big takeaway from this is, whoever wins, whether it's the Republicans or the Democrats, we see continued growth in the economy, and it's going to be sort of a variation of what policies they implement. But overall, it's sort of conducive for economic growth. The only thing we have to consider is the tariffs to see if that causes inflation or not. But overall, I think once we get past the elections, then that clears a lot of people that are waiting, or markets that are waiting to see what happens, and we'll get a clear direction to move forward into next year. So that's a good thing. We'll get clarity in fiscal policy, and obviously we have clarity in monetary policy. So we can see lower corporate taxes, we can see less regulation and this is from both the Republicans and the Democratic side. So the big takeaway is we'll finally get elections past us, and then we'll see which policies get adopted. The most important thing, though, however, is really, if we look at for the past 2 years, it's really inflation. And inflation came on the back of COVID, and that we had in 2020, and this great inflation, this great rise in inflation that we had in 2021 and 2022, where inflation peaked at 9%. And that's what really created a lot of the uncertainty, a lot of the volatility. And then we had the markets in 2022, which were down. And so giving that scenario, all of the central banks, the Federal Reserve the Federal Reserve in the United States, all the central banks increased interest rates to control this inflationary pressure. The positive side is that inflation, for the most part, has been contained, and it's been trending lower since early 2023, 2022, and 2023. And it continues, and it's forecasted that inflation should continue at this level, should sort of base out at a 2 or 3%. If that happens, the Federal Reserve announced about 6 weeks ago that they can see further interest rate reductions. The Federal Reserve meets 2 more times this year, and they can indicate that, again, rates can continue to decline. And more importantly, if for next year, for 2025, the Federal Reserve also expects interest rates to decline, not only here in the United States, but all of the central banks, which is very positive for financial markets, because if with a decrease in interest rates, that's a decrease in money, that's a decrease and that stimulates the economies. So that's a very positive aspect that we've seen over the last 18 months, where inflation has been contained, and then we should have a continuation of that. So that's a very positive note. On the following page, if we look at, again, busy chart, but this is showing interest rates around the world. So this is looking at interest rates since 2006. So we're going back almost 20 years. And we're looking at the European zone, interest rates in the United Kingdom, Canada, and Japan. So the major large central banks around the world. So after the great financial crisis of 2008, 2009, we saw that interest rates really went down to zero for many years, right? We had a little bit of increase in rates in 2018, but for the most part, we've had very low interest rates for about 15 years until we arrived at 2022, right after the pandemic, where we had this great inflation I was shown in the previous chart. And then all the central banks reacted very rapidly and very strong. And so we see this rise of interest rates, very aggressive. And that was really designed to contain inflation. And for the most part, it was, inflation has been contained. And so now we're sort of seeing on the flip side is interest rates are forecasted to decrease. The meeting from the last Federal Reserve, they decreased rates by 50 basis points or 0.5%, which again is a very positive catalyst. And we expect rates to continue to decline into 2025, possibly 2026, which is positive for, should be positive for the overall economy and for financial markets. But again, we haven't seen this phenomena where we've had such a strong rise in interest rates in a short amount of time. Now that's been contained, and now we're sort of on the flip side, which is positive for the markets. So in terms of what this is translated to is, well, as rates decline, and they started declining in the third quarter, what is the impact on financial markets? And so this is a summary of performance on the third quarter of 2024 and year to date for the U.S. equity markets. And so we can see from the U.S. equity markets, whether you're in growth stocks, value stocks, mid caps, they were all up and up significantly. So again, this is to reemphasize that we're sort of in an election year. Equity markets tend to do well. But more importantly is because of interest rate policy, where inflation is contained, interest rates are coming down, and the market is forecasting growth. The market is forecasting continued consumption. And if we have continued consumption, consumer consumption, that translates into profits. And obviously the equity markets tend to underscore and take these growth rates. And not only have we had growth in the equity markets, but if we look in the fixed income markets, and we look at year to date, and we look at U.S. Treasuries, corporate bonds, high yield bonds, emerging market bonds, they've all done well this year as well. Again, this is coming from a couple of years ago, 2022, where if I showed you this snapshot, these were all negative numbers. And so the markets have sort of normalized, have recovered. And just to provide a little bit more perspective on the markets, on this chart, a busy chart, lots of numbers, but here we have a summary of the performance for all the main equity markets, stock markets around the world. So for U.S. equities, we look at the Standard & Poor's 500, the S&P 500, which is the 500 largest companies here in the United States. But not only that, we look at global equities as well. We look at sectors, and to see the performance. And if you can see the column that is highlighted, the S&P 500 is up 22% year to date, which again, is fantastic, strong performance that we've had. And this is on the back of, again, inflation being controlled, the economy continues to grow, corporate profits continue to increase, and that translates to corporate earnings. And so we've had this strong growth. So year-to-date numbers are very good. I want to focus on primarily, three indices just to provide some examples. So I've highlighted the Standard & Poor's 500, the S&P 500, the Russell 2000, which means there are small companies here in the United States, and then the MSCI World, which means there are global equities. So companies around the world, what has been the performance. So the Standard & Poor's, the US market, has led so far this year, up 22%, versus the MSCI World, which are global equities, up 18%, but very close. But we have to sort of look at this in perspective and say, well, if we looked at 2022, and I recall when we were doing these calls, 2022 was a very difficult year. The Standard & Poor's was down 18% that year. Global equities were down 18% as well. The most important thing, though, when we highlighted this to say is the importance is to stay invested for the medium to long term. Because after we have these declines, usually these declines are followed by a sharp pullback or a recovery. So investors that, again, were frightened by the markets in that year and maybe got out of the markets, missed the rally. So the important thing is if you're investing for the medium to long term, stay invested. And then I will highlight how our strategies are very tactical, how they adapt to market conditions, which is very important to manage risk. So overall, if we look at the markets on a 1-year basis, 3-year basis, 5-year basis, positive returns, but obviously markets don't rise in a linear fashion. We do have volatility, and sometimes we do have pullback. The good thing is that the market is up more than it is down, and so the importance is to follow the investment advice of Sanlam Wealth, Private Wealth, and her team, which are very good in terms of providing information and managing client portfolios, utilizing the latest investment technologies that we have available. So that's an important snapshot. And then obviously for investments, this is called a quilt chart because it looks like a giant quilt. And so what this is indicating is the different sectors, the different investment sectors that an investor has to invest. So we have growth stocks, looking at the right-hand column. We have growth stocks, large cap stocks, emerging market companies. We have value companies. We have commodities. We have investment grade bonds. And so the idea of investing is diversification, is not putting all your eggs in one basket. It's really identifying trends in each of these sectors, identifying where we have the best growth perspectives, parameters, and then diversify the portfolio. And this is what our portfolios at Prospero are designed to do, to identify all of these sectors and identify the best combination to invest, with the benefit of looking back over the past 20 years and determine that, not one sector can, not one sector is sort of leads, and sometimes it's cyclical. And so it's really identifying trends from 1 year to another, or from 1 quarter to another, or from 1 week to another. And that's what our portfolios are designed to do, that I'll cover in a second. So diversification is very important. Don't put all your eggs in one basket, but do take advantage of the equity markets, because the equity markets is the single best tool for wealth creation. All the great wealths around the world are created with the equity markets, but that does come with volatility. And so what we take on in terms of when we construct portfolios is to manage those uncertainties, to manage those volatility, to manage those downside swings. So if we do participate in a downturn, we recover quickly and we continue to participate in the growth, which is very important. So when we look back over the past 70 years, if we look back from 1950 to 2020, and we look at the business cycle, and when we look at the business cycle, and we look at where we are in the business cycle, and what can we expect, for the near term, for the near future. So this chart is looking at U.S. stocks in green, bonds in blue, and cash in sort of dark blue. Anytime the equities have led bonds by this significant fashion, it indicates that we're early in the business cycle, right? That we're not late, that we're early in the business cycle. So what we can see going into 2025 is continued growth, right? We just came off, from COVID, several years ago, from this inflation strain that we've had recently, and now we're starting to see the benefits of that. So this indicates, going back 70 years, it looks like, you were early in the business cycle, and we can continue to see price earnings expansion or equity multiples increase. And so it's good to be, to have exposure into the equity markets. Again, this is no crystal ball, it's just subject to change. But if we look at long-term historical trends, we can indicate that we're sort of early in the business cycle, which is positive. So in terms of, before I go into the AI portfolios, so when we look at the main points, we feel that the U.S. economy will continue to grow. The global economy remains in an expansionary mode, which is very positive, led by the decrease of interest rates and obviously consumer consumption. Higher productivity may boost medium to long-term growth, which again, we continue to see good growth numbers in the economy and consumption and corporate earnings. And the only thing to remain vigilant is really on inflation. If Trump does win and he does impose tariffs, that could be inflationary. So we have to sort of look at that. But again, the Fed has indicated that they have been quick to react. And I think they've done a phenomenal job in moving the economy and steering inflation and managing expectations, just by evidenced by the performance numbers that we've had. So that's sort of the overall economic backdrop. Everything remains positive, and we see the continued growth going into next year. Now, what does this mean for our investment solutions and for our investment portfolios? So at Prospero, we utilize a solution out of a UK manager, AI Machines, that really invest into that utilizes artificial intelligence to invest, to identify asset allocation, to identify which sectors to go into. And it's very tactical in nature. Very tactical means that it could adapt, it could move very quickly into different market scenarios. The whole objective of the investment portfolios is to avoid downside participation, meaning, don't participate in, if the market does decline, don't participate in downside. And if they do, then obviously try to recover as quickly as we can. And I'll show you an example of how this, how the portfolios have done over the past several years. So as a summary, we have 4 portfolios. We have the AI conservative portfolio, the balance, the growth, dynamic. I'll focus on the balance and growth for this presentation, but we have these 4 portfolios. And what makes them different is the range in where they can invest. If we look at in terms of equities, so the stock markets and commodities, each of these portfolios have a range where they can invest, minimum, for example, on the balanced portfolio, 40% to 65%. On the growth portfolio, minimum of equities, 60% to high as 85%. So what we do is we give these portfolios ample flexibility to move around from bonds to cash to equity to hedge out equity risk, with the objective of number one, which is avoid capital loss, avoid market participation. And so what we do on these portfolios is they're looking at how to invest, allocate base. And so based on a forecast going out 7 days, the portfolios will adjust and will go serve more bonds and cash, or they'll go more into the growth area, which is equity markets. So that has this ability to dial the portfolios up or down, depending on what they're processing in terms of these forecasts. So when we look at the investment selections, what these portfolios are providing you is really a very broad diversification into the primary markets. So we're utilizing ETFs. ETFs are indices that gives you broad exposure into each of these subsectors. So it's the S&P 500, or looking at the U.S. aggregate bond index, or looking at U.S. Treasury, short-term, long-term, or looking at gold. And so it's really the ability to to diversify, to allocate amongst any of these indices. What this translates to is obviously we want to see what is the performance, but how do they allocate? So I'm gonna do, as an example, I'm gonna show the allocations, the exposures for the AI balanced portfolio for the past 4 weeks, or for the month of September. And so we can see in the first month of September, we can see the allocations that it had from the prior week, right? So for the current week, it allocated into gold, it allocated into QQQ, which is NASDAQ, and then it had a very large position into cash. And this is the important aspect of these portfolios. They manage and they look at risk on a weekly basis. So on a weekly basis, they're examining the exposures and they're calibrating right? To see what is the best combination for that given week with the mindset of meeting objective number one, which is avoid capital loss. So these portfolios have the ability to keep you invested in the markets, but if they see volatility, to increase cash and get you back into the market. So when we look at the first week in September, I had a very large allocation into cash, as we see cash position. And then we look at the bottom part of the chart, the net equity exposures. We can see what was the exposure. So we had 10% into gold, 40% into the NASDAQ, QQQ, and 50% into cash. The following week, right? The following week, it increased exposure to U.S. Treasuries with 20-year maturities, right? It put a 9.5% position. It lowered the cash allocation from 50% to 36%. So we can see how it modified, and then it increased the position into the U.S. aggregate bond or corporate bonds by 5%. So being very tactical in nature from one week to another, we can see a change, increase in bonds where it didn't have bonds before, and so it chose to have bonds for that following week. In the third week in September, it further increased its exposure into 20-year treasuries, right? And so what that provides is we have a decline in interest rates, right? So bond prices move conversely with interest rates. So if interest rates decrease, bond prices tend to increase. So we had a big movement. The Federal Reserve decreased rates, and so bond prices moved up. And so the AI solution identified this trend, and it allocated 33% to long-term treasuries, where it didn't have treasuries before. So showing how tactical it is, it increased exposure to consumer staples, which is a defensive equity mechanism. And then it lowered the cash allocation to only 2%. So from prior weeks, from being 50% in cash, it went only to 2% in cash, and it went heavily into bonds. So it went heavily into a defensive position. And so when we look at the bottom of the page on the net equity exposures, that for that given week, we only had 19% exposure to equities, 51% to bonds. So it went into a defensive position from one week to another. And then the last week in September, it maintained the allocation to U.S. Treasuries, and it follows sort of a very similar pattern for the following week. So this is what the AI portfolios are designed to do, to really look at markets not 1 year out in time, but look at the markets on a weekly basis to manage risk, to avoid capital loss or down market participation, and react. Now, is this a perfect solution? No, nothing is perfect, but this is a very differentiated solution. So when we look at performance, again, I just wanted to highlight cash and so forth. So when we look at performance on an example on our AI growth portfolio, we can see how this over time is designed to provide exposure, the best exposure to equities with managing risk. So how this translates to is, if we look at the year-to-date performance on this portfolio, for example, it's up 11%. Over the 1 year, it's up 22%. But I want to go to the second to the last column, 2022. In 2022, the markets were down. This participated in the down market. So again, objective is avoid capital loss. But if you do participate in the downside, get you back, get you invested to participate in the recovery. And so this is what we saw in 2022, and then it spilled over to 2023, where the portfolio was up 42%. So it made up for all of the lost ground that it had in 2022, and it had a positive return. And this is the strength of this investment solution, is to be tactical, to keep you invested, but it does have the ability to go into defensive positions, as that's just outlined. So this concludes my prepared remarks. I think I exceeded it by 7 minutes, but I wanted to provide exposure. I wanted just to provide a summary of the U.S. elections, which once we get past this, then, we'll get this uncertainty removed from the financial markets. And more importantly, we see very constructive, very positive data going into next year. Again, is not absent of any volatility. We haven't had any volatility this year. We could have a pullback, but again, given where we are in the business cycle, where we are with interest rates, where we are with economic growth, consumer consumption, we see a positive catalyst for the following year. And with that, I would like to sort of conclude my prepared remarks. I don't know if we have any questions or if we can sort of answer questions after this call.
Thanks. Thank you, Jorge. Thanks for the insights there, for the brief on the markets as well. They're just a couple of questions for me, and I've asked the participants as well if they would like to weigh in and ask any questions. So please don't hesitate to just drop the question on the Q&A or let me know, and I'll unmute you. Just one question that I guess it's a recurring question that I have from members. It's more around the volatility. I mean, with the election coming up in the next few days, obviously there are some tensions. There are some members that are quite concerned about the markets being quite expensive at the moment as well. If we're going to see that uptrend, obviously we're looking at history. We know what to expect in markets around this time, but I just wanted to gather your views as well around that, given that we looked at even at performance. You touched on the S&P 500 earlier. It's at a very high at the moment. What are your thoughts around that, Jorge?
No, it's a good question, Anne. I think, with the elections, U.S. elections here in the United States, obviously, if you turn on the television, every commercial is very political. So there tends to be what we call a lot of noise, right? Extreme views. But I think if we look at each of the political platforms for the economy on both sides, that tend to be constructive. So we don't see a protectionist environment for that they could sort of impair growth. When we look at valuations, which is an important point, Dan, when we look at valuations of the S&P 500, the U.S. markets, it is on the higher range, but it's in the higher range because growth is expected to continue, right? Because we came from COVID, from the pandemic to the great pullback, and then we had all this inflation, and this inflation was largely created by supply chains constraints, right? From the pandemic, and so we're starting to see that being normalized. And so the question is, how is the U.S. unemployment rate? And again, we're sort of centric to the U.S. markets because the U.S. market sort of leads the way to the global markets. So when we look at unemployment rate here in the United States, it's very low. When we look at consumer consumption, it continues to increase. And then obviously that translates to profits for companies, and that translates to equity valuations. And that's why we've seen the growth so far this year. The question is, do we see that continued into next year? And we see a very accommodative Federal Reserve policy, interest rates. And so, one of the things that Powell, the chairman of the Federal Reserve, said 6 weeks ago is that he sees that they could decrease rates another 1% next year, 100 basis points, which is a very positive catalyst. When that happens, you usually have, growth areas. Now, this is not absent of any, that doesn't mean we won't have any volatility, because we could have volatility. And so, with these portfolios, as I highlighted, is do we have a mechanism to manage that volatility, right? To manage that uncertainty. And since we're looking at the markets on a weekly basis, we can the portfolios can change, can modify, can adapt, can get you out of the markets, can get you back into the markets with the objective of participation. And overall, I think there's a lot of noise that's been in the market because of political stance and so forth. But I think again, both both parties have policies to provide growth for the economy. The only question is, there's this notion of tariffs here in the United States. Could that be inflationary? And so I think if Trump does win, he'll moderate that policy, and so I don't think he will be able to enact strong tariffs that could obviously slow the economic growth. So I think a lot of it is noise. Once we get past next week, we'll get this out of the way, and then into next year. Again, first year of a new presidential term tends to be positive, but it's largely born on the things that I just mentioned. But good question.
Fantastic, thank you. Thank you, Jorge. I'm not sure if there are any other questions on the floor, but obviously, if you have any further questions, just drop them to me, and I'm happy to coordinate with Jorge as well. If you wanted a more specific question on the AI portfolios as such. Thank you so much, Jorge. I think we are almost out of time. I want to thank you for your time. Thank you for the overview that we went through today. We'll keep our next webinar for early next year, so we'll see how it pans out after the election. But we'll keep our quarterly webinar updates. I think that's a great way to stay in touch with what is happening with the AI and also the global markets update that is a reflection of what we see in our portfolios after. So I want to thank you again for your time and for the presentation today. I will let you know if we receive any questions, and thank you everyone for joining us today and for making the time to listen in. Until next time.
Thank you, Anne. Appreciate your time. All the best.
Thank you, everyone.